This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Darius back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Darius's picture saying, looking for the downloads. Okay, Eric, what are your thoughts here on the equity markets?
Well, Patrick, I'm generally persuaded by Darius's bullish arguments, which I think echo Lynn Alden's bullish arguments, which I was persuaded by last week. Now, my whole rationale for over-hedging left tail risk has been that it's clear to me that Trump and Bessent are willing to disregard financial market consequences of their policy actions, and I think they've got plenty more policy actions planned. But the more I get a sense of what the next round of policy actions might be, the more I agree that they're more likely to be stimulative and near-term bullish equities. Now, I'm still going to hold a left tail hedge here, but maybe if we get a nice dip here that puts my position back in the money, I'll be able to, reduce that to maybe take half the position off because I'm not feeling the conviction or need for that left hedge tail in size that I have it as I was when I put it on. But I do still think that there's reason to have it because I don't think we know and what's going to come next, and I am certain that Trump and Bessent are not afraid to break things in order to accomplish what they want to accomplish, whatever that might be.
So let's just talk about this purely from a technical perspective, Eric. We have a market that has had an extraordinary 3-month run, trading at its 52-week highs, trading close to 300 S&P points above its 50-day moving average, completely overbought. Yet at the same time, structural flows are still in the favor of the bulls, with close to $100 billion of buying still on the table from systematic vol targeting funds, at least according to a number of prominent quants out there that are calculating those numbers. And so the primary trend is clearly higher. We've also made a 52-week highs. So the primary trend is quite intact and arguably can still extend to 64 to 6,600 on the upside. But inevitably, after 3-month bull runs, almost always comes some sort of a 5+% market correction. And the question really becomes, when will inevitably one appear? And should one even do something about a 5% correction? Because even if we returned back to the 50-day moving average with a 300-point correction, odds are very good that it will be bought on dip on the first test. And so if it then subsequently a few weeks later rallies right back up to the highs, how much market timing and hedging was actually required during that? The bigger question to ask is when all of the structural buying finishes, when we get past all of this, are we going to be in a situation where this market has gone too far too quickly and some sort of natural mean reverting correction gets underway? We can only speculate on that, and more importantly, it's likely not going to be a short-term risk. If it is, it's a latter part of the summer into the typical late August, September window, which typically has a lot of weak flows into the market. Nonetheless, on the short term, we're in this tight trade range driven by some gamma pinning from option expiration. Quiet in here. There's definitely room for volatility to return when we get deeper into the earnings season. But at this stage, nothing really a big risk in my mind beyond at some point a very typical pause and 5% correction that happens all the time in the markets. All right, Eric, let's move on to that US dollar.
Tuesday and Wednesday's strong finishes on the Dixie could be the beginning of a counter-trend rally. Now, the market had already rallied quite a bit in the last few days, but that was within the established short-term price channel. These last two closes over the Tuesday and Wednesday close broke the upper trend line, suggesting a more sustained counter-trend move higher might be starting. I remain committed to my bearish fundamental view. 89 is my target longer term on the downside for the U.S. dollar, for the Dixie. But I also remain committed to the wisdom that markets never move in a straight line, and this one is overdue for a counter-trend surprise. I don't know when it's coming, but I'm sure it's coming sooner or later. So the bottom line is watch the Dixie closely for a possible short to medium term counter-trend move. Maybe it's already started, or maybe it's going to fail here. But if it does and we're back down to 96 tomorrow, still keep your eye on this market. I think we're going to get that counter-trend rally, if not on this swing, maybe on one of the next two swings lower. We'll get it at some point, and don't get caught off sides by it. But I'm still committed to it's a counter-trend rally. We're headed lower. Ultimately, I think low 90s, if not high 80s on the Dixie.
Well, my view on the U.S. dollar remains that it is the most consensus short. Everybody out there is bearish the U.S. dollar, and arguably, if you're projecting out 1 or 2 year forecast, certainly the argument that the U.S. dollar could be lower is valid. But on the very short term, after the dollar index went from pretty much the 110 level all the way down to 97, a 13-point swing, inevitably there's going to be a mean reversion, and more importantly, the potential of a short squeeze. When so many traders are in consensus and are all crowded in the same trade, sometimes the counter trend reactions are purely driven by flows and don't even have to have a fundamental reason behind them. The question here, as we approach this 50-day moving average, have we seen this as a pivot area for the dollar, or is this going to reject here at the 50-day moving average and still stay in a primary downtrend? This is the puzzle that we'll be trying to solve here in the next few weeks. The dollar has not really yet shown its hand. What I do, though, want to highlight is that on page 4, I have the chart of the US dollar yen. And what's interesting is this is the first currency pair that is really starting to show that the US dollar has bottomed out and potentially reversing. Not only did we see the low for the US dollar yen back in April, but it's consolidated sideways with a definitive bull breakout here. And so is the US dollar yen really starting to show that something is pivoting and that some sort of US dollar buy cycle may be underway? Let's watch whether other currency pairs start to show these types of characteristics. All right, Eric, let's move on and touch on crude oil here.
Patrick, my directional conviction was weak last week, and it's even weaker this week. My second chance trade has given up most of its profits since we put it on. I didn't actually put it on, since I described it on the podcast a couple of weeks ago. At this point, having given up most of those profits, I would sooner exit than double down on that trade here. I don't have any directional position on in this market. However, I still do have my long on Z5 M6 calendar spreads, as I've described previously.
Well, Eric, my view on crude oil is a little more neutral to bullishly biased in that I don't assign a high probability of crude oil going for a double bottom retest of the lows that it established back in April and May down in the mid to high 50s. At this stage, I think that there's a new structural higher level of crude that will probably stay at the lower range in these mid 60s and an upper range in the mid 70s. And so when we look at the potential trade range that might be established, much like the trade ranges that were established last year in September through March of this year, there's this range of new higher elevated oil prices from where those very bearish lows were established just a few months ago. Overall, though, that doesn't necessarily mean that there's a huge upside for crude oil immediately. I think there's a lot of fundamental things that would have to go in the favor of crude for us to have a stronger run. It's just, I think that the new higher level of crude makes sense, and that certainly could drive some short-term flows continuing into many of these equities. All right, Eric, let's touch on page 6, the chart of gold. It's been in this sideways consolidation for a prolonged period. What are your thoughts here?
Now, we're still consolidating sideways, and in terms of stochastics and converging trend lines and so forth, the short-term symmetric triangle pattern that we've seen here should see some kind of resolution, hopefully within the next week or two at the most, and we'll know where this market is headed. I'm definitely still leaning towards an upside resolution to that triangle pattern, but exactly when that happens or how it happens, who knows? We would need to see a daily close over 3463, 3463, or below 3285, 3285, in order to know for sure. Now, that's a $180 window. That's a pretty wide margin. So there's still time for plenty of ups and downs here before we know the resolution of this triangle pattern for sure. But what we do know for sure is that we're already close to that lower trend line. So if your bias is bullish, as mine is, 3,300 is still a buy here. I wouldn't be adding there because, I just added there the last time we hit it a week ago, and I'm already at my target position size. But if I was looking to add more at this point, I'd put my limit order just above that 3,300 round.
Well, when you look at this chart, it really does continue to look like one big horizontal triangle formation. And we've now seen this multi-month consolidation. Now, this happened 3 times before on this chart. So if you go back through November of 2023 to February, where we had this extended sideways range, or April of 2024 through to July, where it was incredibly tight sideways range, or you take November of 2024 going into January of 2025, again, another like 3-month sideways consolidation. Each time one of those consolidations happened, they ultimately bullishly resolved itself. At this moment, the puzzle to solve is that will that pattern persist? Support along its 50-day moving average, takes a break to unwind its overbought state, and then turns around and has a bull continuation. This is definitely supported by the fact that we have seen some very bullish price action in platinum, palladium, and silver continues to do very well. So the broader precious metals market continues to take flows, and it's very likely that gold is going to maintain some sort of a bullish bias here. Now, even if we saw gold go through a typical kind of 5 to 10% correction, where even, let's say, returned back to 3,000 temporarily, that would just be an extraordinary buying opportunity. I don't at this moment anticipate that 3,000 test, but we are right at the 50-day moving average, which is going to be a very good arbiter of trend. And if we see breakdowns of gold below 3,300, that could mean some deeper correction is underway. But at this stage, I'm maintaining a bullish bias here on gold. Now, Eric, on page 7, I have that Sprott Physical Uranium Trust. And uranium has been such a strong spot in the markets. And now at least the uranium prices have come off. Many of uranium equities continue to hold up along 52-week highs. How do you size this up?
Well, Patrick, as our regular listeners know, I have lots of company in the uranium investing community of other investors hoping, praying, begging for a meaningful correction or pullback that would allow us to add more to our positions at a more desirable location. My fears are being confirmed. I'm afraid that teensy weensy itsy bitsy little correction, you want to call it a correction? Let's call it a hiccup that we just had of about 5 or 6% or so that we pulled back on uranium stocks. I'm afraid that might have been it. That might have been our summer consolidation pullback, your chance to buy the dip. I did buy that, by the way. I've already bought that dip, but I was hoping to buy much more on a much larger dip. I'm continuing to scale in gradually, waiting for that meaningful dip to get aggressive, but continuing to scale in. For me, though, this is only about putting that last 20% of my target position size on. I did most of my buying on the way down, and I bought very aggressively in April around the bottom. So I'm just adding icing to the cake at this point. If I had no allocation to uranium, I would definitely not wait here. I think we're probably already just starting a rally that's going to take off and run. The break on the URA ETF closed Wednesday above $40 for the first time ever, probably, or certainly in recent memory. I think we're probably off to the races here. So if you don't have any exposure to this market, I'd be thinking about immediately putting half of your money to work, then, hoping along with the rest of us for some kind of meaningful pullback to buy the dip on. But I think there's a good chance we just don't see any big meaningful dips.
Well, technically for me, this is actually a critical moment. So we had this, 12 to 14 month bear market in uranium prices. And this rally that we saw over the last 3 months really has shown the characteristics of pivoting the trend back in favor of the bulls. But the real test always in a bull breakout is whether dips start getting bought. And we see the pattern of higher highs and higher lows. And so this pullback here in the spot physical uranium to a typical retracement zone and back to its 50-day moving average is going to be the big tell. We're going to find out whether, in fact, we've transitioned into a new bull cycle and whether the buy on dip traders genuinely do buy the dip here. So we'll watch and see how that continues to develop. Now on page 8, we have that copper chart. Now, and key here is that we're looking at the COMEX copper because obviously the LME copper prices have not moved. This is clearly a tariff-driven move. Well, what's your take here, though?
Well, Patrick, I'm impressed that copper is holding up here, pretty much holding at the same level it was at 2 or 3 hours after the tariff announcement came out. It's impressive to me that it's holding that strong because I think the many people in the media who have seen through this 50% tariff idea and recognized that the president would never impose a 50% across the board tariff on a raw material like copper that U.S. businesses urgently need. Obviously, he's bluffing. This is a negotiation or something. It's not really going to happen. So the big move up that was an obvious reaction to that announcement, it seems like it ought to retrace. It's still a ripe short, but I'm still going to pass on it because I'm so bullish copper longer term that I don't want to lose my position trying to get cute and trade in and out of what's intended to be a long-term hold position.
Well, my take here is that irrespective of whether or not it's impressive that they've held the price up at this level, the bigger question is there more money to be made being in copper? To me, the tariffs have now been priced in. This thing is already ripped with a big premium in it. And so to me, the asymmetry of being long or taking a brand new long position in copper prices here doesn't make a whole lot of sense. And you have the vulnerability that suddenly a new adjustment to the tariff comes out in an announcement and suddenly all of this premium gets pulled out. To me, I remain very neutral here and don't see any high conviction call on copper moving forward.
And Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Well, Eric, on the 10-year, it looks like it's gravitating back towards the top end of its ranges. And this is much more evident on the longer duration bonds like the 30-year, which have already tested the 5% mark. Bonds continue to be a stress point. And while not many people are talking about it, I continue to think that if we were to have a risk event, it would be based on the bond vigilantes coming out here and voting with their money on pushing yields higher on the long end and creating a bear steepener. Will this prevail, and will that be what ultimately spooks the market? We'll see. Now, what's interesting is the 10-year is far more important for benchmarking interest rates, mortgages, and other things like this. That hasn't moved as much, but will a move in the long bonds kind of spill over, causing the 10-year to react? And that's certainly the thing I'm keeping an eye on. The final thing I wanted to just talk about on page 10 is Bitcoin. And normally we don't talk about it, but this was a very clear and distinct bull breakout out of a sideways consolidation that through May and June. This is measuring out a move all the way to 130 to 135,000. It's a very clear bull breakout and has room to go. So let's see whether or not the bulls can finish off the move to that upper target.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.